Hello, folks. It is Friday. It's December the 15th. It's about 3:15 in the afternoon on the East Coast of the United States. In this video, I'm going to talk about the bond markets. In my opinion, the bond markets are the most important of any of the financial markets over the next 12 months. I believe that in 2024, we will have widespread acknowledgement that the Keynesian experiment has ended. And just for background information, it was in the 1930s that Keynes proposed the idea basically that, governments could live on debt. All they had to do was issue their debt instruments, and that would allow them to basically, they could do anything they wanted to do. Finance their governments, finance world dominance, etc. And then in 1971, when Nixon closed the gold window, the Keynesian experiment kicked into full gear or high gear, however you want to look at it. And since that point, the expansion of global debt has just gone, it's gone exponential. And so anyway, I believe that in 2024, we will see that system has well and truly ended. And it will be interesting to see what the consequences of the end of that system are. And so anyway, let me share my screen here, and we'll jump into this video. In the big picture, just got a few things to talk about. So obviously we had a shift this week. At the end of this week, we went from, higher rates for longer. That was, 2 weeks ago, that was the story. We're going to have higher interest rates for longer than anybody expects. And then this week we get we're going to pivot. And of course, my belief, and there are other people talking about this as well, is that Powell, the Fed chairman, obviously, Jerome Powell, he got the call from the White House, and the White House said, hey, it's an election year in 2024, and we need you to play ball. And so that's what we saw this week, is that Jerome Powell is playing ball with the Biden administration. And so now he's talking about a pivot. And of course, we also have, here it is, middle of December, and not uncommon that the stock markets rally into the end of the year and early January. The Santa Claus rally is how it's referred to. And so again, the idea of a pivot in interest rates is appropriate at this time of the year if you are Wall Street and trying to instigate, perpetuate a rally into the end of the year. Now that doesn't say anything about what happens come January 1st or January 15th, the month from now. Something will come along. There'll be some reason why the Fed pivots back to, okay, now we need to raise interest rates because, whatever, insert excuse here. And the stock markets will head lower because of, again, insert reason here. But anyway, for now, rally into the end of the year, going to pivot in 2024. I think the market's currently pricing in six interest rate cuts in 2024. It's just, I just have to shake my head, but believe what you want to believe. But anyway, it appears that that's the current story, the narrative, if you will, for 2024 in interest rates. Now, let me talk about the world of interest rates as I see it. And again, believe what you want to believe. All of us have to decide what we believe about the financial markets. And how it is appropriate to invest our money based on what we think the financial markets are up to. So anyway, here's Brian's picture of this is the financial markets, in particular interest rates in 2024. Well, so $7.6 trillion in US debt instruments will mature in the next 12 months, and that debt has to be rolled over. There is no ability to pay off this debt. We don't have $7.6 trillion. We don't have that much income that will come in 2024. And so anyway, $7.6 trillion in maturing debt will have to be refinanced, rolled over in 2024. Point number one. Point number two is $3.4 trillion worth of deficit spending will occur in 2024 based on the current trend. And we'll look at an article here in a sec that supports that idea. So $3 to $4 trillion in deficit spending during 2024. So if we add those two together, we get 10 to 12 trillion dollars of US debt instruments that will have to be sold in 2024. 10 to 12 trillion dollars. That's a fair chunk of change, folks. I don't know about you, but I'd do pretty well. I think I could struggle by on 10 to 12 trillion dollars. But anyway, this is a sub point. Corporations are also issuing debt instruments. It's not just the central banks of the world, the US Fed, EU, etc. Corporations are also issuing bonds, debt instruments, and we'll see again, article here in a sec that, this is likely to be in 2024, most of $1 trillion, so $1 trillion worth of debt instruments that will be competing with this 10 to 12 trillion dollars in US debt instruments. So anyway, there's a lot of debt that needs to be sold in 2024 if the central bankers are going to continue their Keynesian experiment. And again, as I have stated, I think that 2024 is when there is widespread acknowledgement that that system is done, that the Keynesian experiment is over. But, we'll pop some popcorn and watch. We'll see what happens in 2024. Another bullet point that supports my premise that the Keynesian system has done is that foreigners have stopped buying US debt instruments. And in particular, when we're talking about foreign buyers of US debt instruments, we're talking about Japan and China. Both of those countries have stopped buying, or essentially stopped buying, US debt instruments. And of course, they were the major buyers. There are other foreign buyers, but they aren't going to suck up 10 to 12 trillion dollars worth of US debt, simply not going to happen. Now, there is some level, and this is just Brian stating his opinion. I don't have any facts. I can't present any facts to support this idea. But in my opinion, there is surreptitious quantitative easing. That's basically, that's a polite way of talking about running the printing presses and buying your own debt. That's what quantitative easing is in reality, is that we print up fiat currency and we use that currency to buy our own debt instruments. And that's what QE is in reality. I believe that surreptitious QE has been occurring since the early 2000s, at least. You know, it's where the Fed Treasury prints up, you know, pallets of Benjamins and ships those fiat notes, you know, hard currency. We're talking about real paper money, pallets full. And it gets shipped off to foreign destinations, Cayman Islands, Belgium, miscellaneous places in the Middle East. And then those countries turn around with those pallets of Benjamins and they use it to buy US debt instruments. And so that's what I'm referring to here when I talk about surreptitious QE. That's foreign buyers buying US debt instruments with fiat currency that came straight off the printing presses here in the United States. That's surreptitious QE. But in my opinion, when you're talking about 10 to 12 trillion dollars worth of debt instruments to be sold in 2024, surreptitious QE is not going to cover that amount. There's no way in hell they can print 10 to 12 trillion dollars worth of Benjamins, put them on pallets and ship them off to foreign countries, and then turn around and buy US debt instruments with that money. Just in my opinion, that can't occur, won't occur, is not going to occur. So anyway, we're not going to be able to fake 10 to 12 trillion dollars worth of debt instruments in 2024, which means, and this is the main point in my slide here, the big picture, a return to openly acknowledged quantitative easing. That the Fed will have to come out and they'll have some narrative. It'll be, you know, who knows what it'll be? War in the Middle East, war in Europe, war somewhere. What's Guyana in South America right now is another hot spot. War with Taiwan and China. I mean, you know, who knows what the narrative will be? But in my opinion, there'll be some narrative in 2024 that will provide the justification for the Fed to return to open QE. And of course, the reality is that the reason they'll be returning to open QE is to finance this 10 to 12 trillion dollars in to buy US debt instruments. It's basically they're going to run that amount of Benjamin's going to come off the US printing presses and will be used to buy US debt instruments in 2024. So sigh. Let's keep rolling here. I'm being long-winded in this video. In my last video, I mentioned the global South, and I had intended to mention that when we're talking about the global South at this point, we're talking about 85% of the population of planet Earth. 85%. I mean, yeah. So it's like basically the Western world at this point, I think, is about 12%. About 12% of the planet can be categorized as the Western world. The rest of it is the, you know, quote unquote, the global South. And you know, another way of looking at the global South is the Belt and Roads Initiative, BRI. So currently there are 195 countries on planet Earth. Well, 148 of those countries are participating in the Belt and Roads Initiative. 148 out of 195. So when we talk about the global South, I just want you to understand that we are talking about almost all. I mean, when you're talking about 85% of the planet's population, that's almost all of the planet. Basically, the Western world at this point, 12%, we just don't count. I mean, well, yeah, we got the big military forces, and the United States controls the economic system with its U.S. dollar. But when you're comparing 12%, the Western world, to the global South, I mean, there truly is no comparison. And so, just I want to emphasize that point. And something that just occurred to me, I forgot to put on my slide here for the big picture. In 2024, Russia is the rotating leader of BRICS. And so that is significant in my opinion. And I think it's a good idea that the BRICS rotates the leader of the organization. And I don't know offhand, is that a yearly thing? Do they get a 2-year term? I don't know. But anyway, in 2024, Russia is the leader of the BRICS organization. In November of 2024, we have the next BRICS summit. It will be held in Russia. And of course, in January of 2024, we have 6 new members of the BRICS organization. Maybe it's only 5. Argentina at this point is kind of, maybe they will, maybe they won't. Milei, the new leader of Argentina, is saying that, well, he's actually said both. We will join BRICS. No, we won't join BRICS. And so who knows at this point. But anyway, we're going to have at least 5 new members of BRICS in January 1, which is that's 2 weeks away, folks. We're going to have at least 5 new members in the BRICS organization. And at that point, BRICS will control 80% of the global production of oil. And so, at this point, if you want to talk about who controls the financial system on the planet, well, it's BRICS. Because when you boil everything down, let's cut to the chase. It's all about energy. And so when you're talking about an organization that controls 80%, 80% or more, I've seen 85% of the petroleum production on the planet, basically they're in control. And of course, we could talk about the petrodollar, which at this point is shifting into the petro yuan. But let's not go there for now. Let's keep rolling with this video. I don't want to be too long-winded here. Just a couple of articles that I want to share. Let's see, this is October 5th of this year. What's my highlight here? Treasury auction sizes will rise by an average of 23% across all maturities in 2024. And of course, this goes along with the fact that we've got all this maturing debt. They are going to have to roll those debt instruments over, and subsequently, that's why the size of all of these bond auctions will increase. And it's like they're saying here, across all maturities, average of 23%. Well, foreign buyers aren't showing up at these auctions. I mean, they're able to pretend. The last couple of auctions have gone, well, we've had a couple that have gone well. We've had a couple that didn't go well. And so anyway, a lot of games going on at this point in the financial markets, in my opinion. So, but anyway, Treasury auction sizes will increase significantly in 2024. That's one of the things that we're going to see next year. This article is supporting the idea that corporations are also selling debt. And so they are competing with the US government and all the other central banks for selling their debt instruments. And this article is saying, you know, 770 billion in 2024, and then almost $1 trillion in both 25 and 26. And so anyway, we have a significant amount of debt that the corporations are going to try to sell going forward. And I guess, you know, if you are a major investor, you have to decide, would I rather invest in the debt of the US Fed or in the debt of Apple, Ford, NVIDIA, you know, whatever corporation you want to name? Where do I want to invest my money? And that's why it truly is a competition. You know, where do major investors feel safe putting their money going forward? So just keep in mind that corporations are competing with the federal governments. So this article is just talking about, and that's where I got the $7.6 trillion number that I shared in my slide deck bullet point. That's the amount of debt that will mature over the next 12 months. And that debt will have to be rolled over. New debt instruments will have to be issued in that amount going forward in 2024. So now we're into the charts. This is my big picture chart on interest rates. This is yield on the 1-year Treasury bill. Obviously, we've had a big pullback in the last 2 months on interest rates. You know, not surprising to get a correction in interest rates. I mean, you know, look at that. Where's that move start? November of 21. So basically, yeah, 2 full years. We've had 2 full years of basically straight up in interest rates. You know, you see it right there. That's a vertical move. That's a dramatic increase in interest rates. So in comparison, this is a teeny tiny pullback. You know, this is nothing. The last 2 months, this pullback in interest rates is nothing compared to what has happened in the last 2 years. But you know, anyway, there it is. So for the last 2 months, we've got this teeny tiny pullback in interest rates. But it's been a while since we've looked at this chart, so let's just talk about it a little bit. What I always point out with this chart is that when interest rates in this chart are moving vertically, bad things are happening in the economy. You know, this was the global financial crisis. That was the big scary plunge in March of 2020. We haven't come up with a name yet for this current vertical move. That's why I have the question marks. Now, in my opinion, in hindsight, what we will label this as is the global debt collapse. That basically this move in interest rates will be attributed to the global collapse in debt instruments, sovereign debt instruments. Or perhaps we'll label it the end of the Keynesian debt-based fiat system. You know, that would be even better. If we were able to say that, yea, verily, during this 2-year period, the Keynesian fiat system ended. You know, we'll see. But anyway, that's why I have the question marks here, is that we don't know why this vertical move is occurring in interest rates, but we can be pretty confident that it's not good. Whatever is going on here, it is not good. So, and then just, you know, some other stuff. In my opinion, it was in December of 21 when Evergrande defaulted on $300 billion in debt instruments. That was what kicked off the collapse of the debt markets. And that's what I have marked here. Here in June of 2022, that's when ECB and the Fed, they started outright buying debt instruments. Banking collapse occurred. We had 3 big banks collapse in March of 23. Evergrande officially declared bankruptcy back in August of 23. And so anyway, this chart it shows us the big picture of the debt markets. 1 year, the yield, I was expecting a break higher from this chart. Obviously, we've gotten a break lower. Again, not surprising that we're getting a pullback after this big vertical move. So based on MACD, we're still in bull mode, which suggests that the primary trend in this market is to the upside. Currently on a sell signal, energy is very low, and this is in the weekly time frame. 2 years, I was expecting a break higher. So we had this uptrending channel, and my expectation was, and the megaphone pattern. And so a megaphone pattern typically resolves to the upside. And so I was expecting a strong impulsive break to the upside from this megaphone pattern and this upward sloping channel. Obviously, that's not what has occurred. We've gotten a break to the downside and a push below this horizontal support resistance level. So MACD again in bull mode, primary trend to the upside, currently on a sell signal, energy is low. 5-year weekly time frame, big pullback, push below the 40-week moving average, which could have been support. Obviously, for two weeks there, it acted as support. We've pushed below that level now, perhaps finding support on this would be the lower median line extension of this Andrews pitchfork, potential support level. MACD in bull mode on a sell signal, energy very low. 7-year, more of the same, push below 40-week moving average, MACD in bull mode on a sell signal, energy very low. 10-year, so break. This is daily time frame. So we've gone from weekly to the daily time frame in this chart. My expectation was that we had bottomed, at least temporarily, in this chart, and the next move would be to the upside. Clearly, that's not what happened. Yesterday, we got a break lower and significantly a gap lower. Let's zoom in here a little bit. Yeah, it actually looked better at this level. A gap lower from the 200-day moving average, which, that's a very common support level. So significant when we get a gap down from that support level. That occurred yesterday, and then continuation today. And then also, if we look at MACD, we were at yesterday, or the day before yesterday, we were at a level in MACD where it would have been reasonable to expect a reversal to the upside. And of course, that's not what we got. We actually got MACD pushing lower through the level of these prior lows. And, as I've pointed out before, quite often we find that these prior lows and highs in MACD, price will also reverse at those levels, but that's not what we're seeing at this point in the 10-year. So let's keep rolling. This is 20 year. We're back into the weekly time frames again. Impulsive push through the 40-week moving average. And note, impulsive meaning price is at the low or very close to the low of that price bar. That's an impulsive price movement when price closes at or close to the low in this case or high of the price bar. So anyway, impulsive move to the downside. Let me just interject. These moves in interest rates are occurring based on the hot air from the talking heads at the Fed and on Wall Street. You know, we got the basically Powell coming out and saying, hey, we're going to pivot. And then we're getting the talk from Wall Street saying we're going to have 6 interest rate drops in 2024. Well, that's all bullshit. My opinion, that's not true. As I have stated, in 2024, they have to somehow they've got to sell 10 to 12 trillion dollars worth of U.S. debt instruments, and corporations are going to try to sell $770 billion worth of debt instruments. So, you know, that's what's that combined. 11 to 13 trillion dollars worth of debt needs to be sold in 2024. Well, you don't sell that much debt by lowering interest rates. Well, you don't sell it legitimately. And of course, again, that supports my idea that we are headed back to openly acknowledged quantitative easing. And it's going to be big. It's going to be big. Oh, man. Which, of course, is a good thing for the precious metals. You know, if you're a precious metals bull and you're thinking about, okay, what's 10 to 12 trillion dollars worth of quantitative easing going to do for the precious metals markets? Well, gold's going to head higher and probably a lot higher when it becomes openly acknowledged that we are back in quantitative easing, and the magnitude of that quantitative easing is going to dwarf anything that has come before. I mean, it's 10 to 12 trillion dollars, folks. I mean, wow, it's a lot of money. Yield on the 30 weekly time frame, again, big impulsive move below the 40-week moving average. MACD in bull mode on a sell signal, energy very low. Notice so far that all of these charts that we've looked at, MACD remains in bull mode, which means that the primary trend is to the upside. So yeah, right now, okay, interest rates are dropping. Well, yeah, it's a pullback. Primary trend is to the upside. Sigh. This is a look at, what is this? Okay, so held to maturity. So when we talk about banks and interest rates, one of the things that happens, you know, banks and pension funds, they invest in debt instruments. And at the point of buying those debt instruments, they go onto the books, the asset books, and the banks may intend to hold those instruments long term. They may just be taking them as trading positions. But then at some point, they decide, well, I'm going to hold this thing until it matures. And of course, what has been happening for the last 2 years is that the banks have been flipping debt instruments onto their held to maturity books in dramatic scale. I mean, you know, and there it is, you know, visually. What do I mean by dramatic scale? Well, there it is in the chart. It's a damn near vertical line. This is banks deciding that, well, we bought that bond. And at the time we bought it, we thought, well, maybe we'll trade it, maybe we'll keep it. But now they have definitively put it onto their books as being held to maturity. Doing that on their books lets them put it into a different category when they do their federally required reporting, that now it's held to maturity, and they get to count it differently. That basically they don't get penalized for held to maturity debt instruments. And so we can see this dramatic rise from, what was that, $1 trillion up to now we're at almost $3 trillion worth of held to maturity assets on the bank books, which, that gets at what is the health of the bank sector. They ain't healthy. We had 1 week, one month or 1 week, I forget. 64 banks, 64 bank branches, not banks, bank branches were closed, all in the space of whether it was 1 week or 4 weeks. A significant number of bank branches were closed in that short time period. The banking sector is not healthy, just as a side note. So let's keep rolling. I'm taking up way too much time in this chart. This is just the charts that I'm sharing here. They give us an idea of what's going on behind the scenes in the banking sector and in I call it the retirement financial sector, if you will, the pension funds, the, places like CalPERS, the big educational retirement funds, if you are expecting a pension, basically whatever institute is holding your pension, your expected pension, this is insight into the health of that institution, because those those kind of entities, those retirement funds, they invest in the debt instruments of the federal government. That's one of their major investments. And so these charts give us insight into what is happening to the investments of those major institutional investors. So this is Vanguard Bond ETF, monthly time frame. These are investment grade US bonds. So federal debt instruments, no tips, no municipals. We can see this, huge drop, 89 down to 68 in that, roughly 2 year period, 24% loss. Of course, we've gotten a big bounce in the last 2 months as interest rates have pulled back. And so, probably if you get statements from those entities, they're talking about, oh, we're up, what's that? Almost 3%, 4%. So they're making a big deal about, ooh, we're up 7%. But what they're not talking about is that they're down, they were down 24%, and now they've gotten a 7% bounce. Yeah, it doesn't sound so exciting, does it, in that context? And of course, something I would point out as a trader and technical analyst, this looks like a counter trend rally. When you get a steep movement against the primary trend, that's simply a counter trend rally, and the reasonable expectation is that counter trend rally will quickly peter out and reverse, which of course in this case would mean a reversal to the downside as interest rates start rising again. So this chart is showing us, this is the Bank Term Funding Program. This is the program that was set up to the objective was to prevent banks from selling their underwater bonds, because because of this, the value of the value of the bonds that they had invested in was dropping so steeply. The Fed did not want them to sell those bonds. As I pointed out, they've got $10 to $12 trillion worth of new debt instruments to sell. They don't want to compete with banks and retirement funds who are also trying to sell bonds. And so by establishing this bank term funding program, basically what they've done is eliminated some of their competition. They're lending money to those banks so they don't have to sell their debt instruments that are deeply underwater. And so we can see, this lending program is continuing to rise. Looks like currently we're pushing $124 billion in this program. Now, interestingly, this was started in March of 2023, and it was set out as a 12-month program. This was a temporary program. And of course, there's nothing more permanent than a temporary government program. and that is my expectation with this program. It will become permanent. Now, it almost certainly will not be widely advertised that this temporary program has become permanent. But in March of 2024, when this program should end, based on its original, the terms under which it was created, it's not going to end. It will become permanent, because if they ended it, well, that's $124 billion worth of debt instruments. Well, no, they wouldn't immediately be put on the market for sale, but that would be $124 billion worth of underwater debt instruments that would then negatively be counting on the bank's books, which of course weakens the banking system, which is already weak enough. And so anyway, that bank lending program will become permanent in 2024, in my opinion. This is a 20 plus year bond ETF. These are sovereign debt. So US debt instruments down 53% prior to the rally of the last 2 months. And again, that's a counter trend rally. My expectation is it'll roll over pretty quickly. I'm going to speed up. Another 10 to 20 year bond ETF, 45% loss before the rally. Mortgage-backed ETF, 24% loss, big bounce. These are, Fannie Mae, Ginnie Mae, Freddie Mac. Treasury ETF, 6 years is the effective duration. Big rally after a big loss. This is 25 plus, so long-term, effective duration, 26 years, big bounce. What do we got here? S&P 500. So this is the stock markets. How'd that chart sneak in there? Let's not look at that one. Let's look at the NASDAQ. So this is NASDAQ. Now we're looking at the daily time frame. Obviously, when the Fed pivoted or started talking about dropping interest rates, the equity markets rallied. New all-time high I think in the S&P 500, maybe in the obviously in the NASDAQ as well. I'm not sure about the Dow, but probably in the Dow as well. So anyway, new all-time highs in those markets based on talk. Emphasis on talk. 2024 is going to show that the talk was bullshit, but based on talk, we've got new all-time highs in the equity markets. And of course, that's what we're seeing here. Based on MACD, very overbought and pushing up into the level where price has reversed. You know, price can do whatever it wants based on MACD, but getting very overbought based on MACD, currently on a buy signal, obviously, energy very elevated. While I'm thinking about it, if you are an active trader and you enjoy trading, not unreasonable to expect based on current talk from the Fed, Wall Street talking heads, that we will see a Santa Claus rally this year into the end of the year, early July or early January. And so, active trader, nimble trader, meaning you put your money in the market, but you got a hair trigger on the sell button, you know, that you're ready to bail when it's appropriate to do so. Might not be unreasonable to expect a Santa Claus rally in the equity markets. Now, this is not financial advice by any means, folks. I am not an investment advisor. I'm not anymore. I gave up my registration as an investment advisor. I don't want to be responsible for how you invest your money. That's for you to decide. How do you feel comfortable investing your money? But just, you know, as a casual observer, in my opinion, it would not be unreasonable to expect a Santa Claus rally this year. In this chart, and I shared this recently, this is in the upper panel, we are looking at the NASDAQ US Buyback Achievers Index. And basically what it's showing us is described right there. These are the corporations who have bought back more than 5% of their outstanding shares. That's a lot. You know, when you're talking about a corporation like Ford or Nvidia or Apple, to buy back 5% of their shares, that's significant. That's a lot of damn shares, a lot of money, more importantly. And so anyway, we can see, and this is the daily time frame, we can see that after the Fed's announcement of basically a pivot, well, they didn't announce a pivot, but they started making noises like they're going to pivot in 2024, which, you know, the only way they can pivot in 2024 is by openly returning to QE. And so they can do that. They can pivot. They can return to QE. As a precious metals bull, that's good for me. You know, so, you know, anyway, we'll see what happens. But what we're seeing here is that after Powell's comments about a possible pivot, we get a big jump in corporate buybacks. So the corporations are buying back their shares. And of course, the equity market's moving to new all-time highs. One of the, if I'm remembering correctly, one of the buyback announcements in the last week or so was Ford. They had been planning to invest $23 billion into their electric vehicle program during 2024. And because nobody is buying nobody with intelligence is buying electric vehicles, and I apologize if I'm stepping on your toes with that statement, but electrical vehicles are environmentally dirty. They are meant as an instrument of control. When they decide that they want us to live in our 15-minute cities and not travel outside of those cities, all they have to do is turn off the electricity. Well, when they turn off the electricity and all you have is an electric car, what the hell are you going to do? And so again, I apologize if I'm stepping on your toes with this comment, but smart people are not buying electric vehicles. People that want to virtue signal are buying electric vehicles. And anyway, the market bears me out on this. And most telling for me, if you go look at, I'm going off on a tangent here. If you look at the rental car companies who made the decision to invest in electric vehicles, what they are finding is that those electric vehicles are the very last vehicles that get rented. People don't want to rent electric vehicles. And so the electric vehicle or the rental car companies are kind of feeling stuck with these electric vehicles. New electric vehicles are backing up on the dealer lots. People aren't buying them. The dealers don't want any more of them because they're already stuffed to the gills with the darn things. And so anyway, point is, in last week, Ford announced that they had been planning to invest $23 billion in 2024 into their electric vehicle program. They cut $12 billion out of that investment. So $12 billion, they're not going to invest. They're still going to invest in electric vehicles, but not to the tune of 23 billion. They cut by 12 billion, and they're going to use that money to buy back their own shares. And so that's my point here. This is one of the key things that is driving the current rally in the equity markets. It's corporations buying back shares in their own stocks. And so if you're thinking as an equity investor, oh, the economy's healthy, people are organically buying stocks and investing long-term in the markets. No, that's not what's going on at all. This equity market is driven by corporations buying back their own shares. And then, of course, this week it's being driven by the talking heads expecting a pivot and pumping the idea that there'll be a pivot in interest rates in 2024. So anyway, enough of me babbling. Just want to share this. This is the gold chart. This is COMEX futures, February 2024. Big gap. So this was the 13th. What was that? Wednesday? This Friday, Thursday. Yeah, Wednesday. So Wednesday into Thursday, we got a $47 gap between the close on Wednesday and the close on Thursday. $47. And so that's a pretty significant pop in the price of gold. And again, that's related to the Fed's pivot or talk of a pivot. See, they can't have it both ways, folks. They can't have the price of gold down and continue to support lower interest rates. When they go to openly acknowledging QE in 2024, the price of gold is going to soar because as people realize that we're, in 2024, 12 months, they're going to print off their printing presses $10 to $12 trillion. $10 to $12 trillion going to come rolling off the print press in 2024. Now, what's that going to do to the price of gold? Oh my. So anyway, I apologize for rambling in this video, folks. I'm going to cut it off here. I look forward to talking to you tomorrow. Oh, speaking of tomorrow, so I'm setting a goal for myself. I'm going to do a daily video at least for the next 30 days. I'd like to reach 1,000 subscribers on my YouTube channel. When I reach that level, I'm going to go to Miles Franklin, their bullion dealer, and become a dealer in the precious metals so that I can provide you with an alternative place to buy the precious metals. Now, of all the online bullion companies that I've seen, Miles Franklin is by far the best. Just can't compare. And so anyway, I'd like to become a dealer for Miles Franklin. And so if you would, if you've not already subscribed to my YouTube channel, I'd appreciate if you do so at this point. And that's all I got in this video. I'll talk to you tomorrow. See you, folks.